All right, everybody. I got to get used to this. All right, let me talk a little bit serious here now. I want to talk about the stock market. Just, my feelings about where we are in terms of this stock rally, in terms of the fiscal flows. Now, as you know, and if you get the MMT Trader, you know this, and I've mentioned it on these videos, that the fiscal flows are positive. In other words, they are rising year over year. That's the main thing that I look at. I mean, when it all comes down to it, it's really about federal government spending, because that's kind of the way the United States economy is set up, and that's kind of the way we relate to the rest of the world, and I'll explain that. First of all, to the rest of the world, where we run trade deficits because the rest of the world has to, by necessity, run trade surpluses with us in order to acquire dollars. Oil is priced in dollars. Lots of very important goods and commodities priced in dollars. They need the dollars, number one, to purchase oil, primary source of energy. And the only way they could acquire dollars is to sell us stuff. Okay, so they'll do whatever it takes. It's not like, you always hear these people say, oh, we spend too much, we're profligate spending. No, it has nothing to do with that. Has nothing to do with that. I mean, the reason why China and Japan and all these countries erect impediments to trade and suppress the wages of their workers and engage in currency manipulation, they have to. Okay, because they have to gain some competitive advantage in order to run trade surpluses with it. We all make the same stuff now. I said this in the past. It's not like, the 18th century when we're trading British wool for Portuguese wine. No, we all make cars, and we all make textiles, and we all make electronics, and we all make toys, and we all make consumer goods. We all make the same stuff. So what gives one country an advantage over another? They have to do this. They have to acquire dollars to buy oil, period. And also the world, there's a desire to net save in dollars for whatever reason. So, they have to run trade surplus. All right, so we always have a trade net exports in GDP. That's always going to be negative. That's always going to be negative because the rest of the world has to run a surplus with us in order to acquire dollars. All right, so that is not net consumption on the part of the rest of the world. It's like net saving. Okay, number one. Domestically, the non-government domestically, that is a net saver. Okay, we have a positive savings rate. Might not be a lot, but it's a positive savings rate. So on balance, the net domestic non-government part of the economy is a net saver. So what does that leave? You have the foreign sector saving. You have the domestic non-government saving. The government has to spend money, all right? So that's why I look at the fiscal flows. It comes from there. Now, we are up year over year, but we're not up by a lot. We're up about 1% versus last year, which is a good improvement because we started off the fiscal year last October, we were negative. And we were negative all the way to the end of December, like December 28th. And then we started to go positive. And it's been a slow and gradual improvement in that positive year over year. Although I have to say the last couple of days it slowed down again, but we're still positive. That could be a temporary low. So last year, when we had the second strongest federal spending year on record, remember that? I kept talking about that. I kept pounding the table, positive for stocks, on every dip. Stock market was up 6%. The S&P was up 6% from the beginning of the year going into the election. Since the election, it's up 8%. Why is it up 8%? Well, we got a little bit more government spending, but we got quite a bit more foreign sector saving. We have a bigger trade deficit. Okay, that's another way to say the foreign sector is not spending as much, net spending. So that takes away from what the government's been putting in. All right. But we're up 8%. We're up 8%. Why? Because everybody jumped into the market thinking Trump. Remember, Trump's going to do a fiscal stimulus. He's going to do a tax cut. He's going to do infrastructure building. Big, big things. Big, big things. Where are the big, big things? The only thing we got so far. Let's break it down. The only thing we got so far was a freeze on federal hiring, which luckily has not impacted yet federal salaries. There's still the outlays for federal salaries are still positive and rising year over year. So that's good. It hasn't hit it yet. Maybe it will. I don't know. And we got some minor, regulatory rollbacks and stuff like that. We didn't get the big, big things. The big, big things didn't happen yet. So we're up 8%. Meanwhile, we've been talking about bank loan growth. I mean, you look at that thing. If you got the MMT trader, look at those charts. You'll see them. It's falling off a cliff. But that's growth, okay? I understand the nominal level is up there near all-time highs. Anyway, you put it all together. For me, I think stocks should be flat, maybe up a couple of percent. The 8% is an embedded optimism. That's what that is. This is an embedded optimism on the part of, and who, think about it. Most market moves in the short run are dictated by masses of people who do not know what the hell they are doing. They just do what everybody else does. All right. I'm not saying stocks are a great investment and over time they go up. I'm just saying right now, when I look around and I, sort of take a reading on what's happening fundamentally with the economy, with the fiscal flows, with the foreign sector, with all that stuff, I don't see where we get an 8% rally in stocks. Not to mention, if you want to break down, I look at the commitment of traders that the CFTC puts out every Friday. Asset managers, you're talking about the BlackRocks, Fidelities, Vanguards, these big institutional asset managers, maybe some hedge funds in that category, whatever. They are long almost 580,000. This is net long. This is longs minus shorts. Net long 580,000 S&P E-mini futures contracts. And which is the highest they've been in over, I went back more than a year. The swap dealers, those are the Wall Street firms. That's like the Goldmans. That's like the JP Morgans. That's the Morgan Stanleys. I'm not saying those guys are so, smart necessarily. But they are on the other side of that trade, short 222,000 contracts. Speculators, the leveraged money, and the small specs, they're net short. The rest is people who are in spread positions. But that asset manager position, and those guys, they just do the same thing as all the rest of them do. They listen to CNBC and they read the Wall Street Journal, all the crap information. They're long 580,000 contracts, and the smart money, I think, which is the swap dealers right now, they're short 222,000 contracts. So anyway, that's the breakdown. That's how I see it. See you later. Bye-bye.